S&P 500 Index, SPX, Long-Term Chart Analysis. The S&P 500 Index, SPX, continues to garner attention with its notable movements and the potential for further upward momentum. Our previous analysis emphasized the bullish trend as the advanced decline line hit new highs. Let's explore the recent developments and their implications for investors. Weekly performance and current market position. This week, the S&P 500 Index, SPX, experienced a strong upward movement, gaining plus 1.18%. This increase supports our bullish outlook, indicating the market is on a positive trajectory. The 200-day moving average was instrumental in curbing the selling pressure seen in early August. The conservative S&P 500 strategy is tailored to protect investors from bear markets, allowing for short-term declines without triggering sell signals based on temporary market fluctuations. In contrast, the aggressive report offers a more detailed analysis of short-term indicators. Understanding the conservative strategy. The conservative strategy relies on long-term chart analysis and avoids decisions driven by emotions or news events. This approach focuses on the long term, allowing for market fluctuations without attempting to time every minor movement. Currently, we maintain a bullish stance in the RightX S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs like SPY. Economic indicators and market trends. Recent economic data presents a mixed view of the U.S. economy. Last week's Labor Department report highlighted a significant increase in job additions for September, suggesting a stronger than expected employment scenario. Despite these positive indicators, some economic factors have not aligned as anticipated. Impact of Federal Reserve's policies. Interestingly, while the Federal Reserve's easing measures were expected to reduce mortgage rates, the opposite has occurred. The 30-year mortgage rate rose from 6.23% to 6.56% this week, contrary to expectations. This rise is closely linked to the 10-year U.S. Treasury yield, which also increased during this period. Friday's strong jobs report further supported these trends, pushing the average 30-year fixed mortgage rate higher. Since Fed Chair Jerome Powell's interest rate cut by 50 basis points on September 18th, the average 30-year fixed mortgage rate has increased by approximately 47 basis points, reaching 6.62% from 6.15%. Market volatility and election year dynamics. As the U.S. presidential election nears, investors should prepare for increased market volatility. Historically, holding cash during such periods has not been a profitable strategy for investors. The stock market is entering a volatile phase, but the underlying rally may continue. Economic reports and their implications. Several key economic reports released this week have influenced market dynamics. The yield on the U.S. 10-year Treasury note rose above 4%, marking the highest level since late July. This development, along with a strong labor report, has diminished the likelihood of another 50 basis point rate cut from the Fed in November. The Consumer Price Index, CPI, data showed a 0.2% increase in September, slightly below economists' predictions. The trend remains bullish, yet the market is considered overbought, warranting caution amid potential volatility. Unemployment and inflation trends. Unemployment figures also made headlines, with a notable increase in individuals filing for unemployment benefits. The total reached 258,000 for the week ending October 5th, exceeding market expectations and marking the highest level in 14 months. This rise was largely driven by states affected by Hurricane Helene. Inflation and consumer sentiment. In terms of inflation, U.S. factory gate prices remained flat in September, missing expectations of a 0.1% rise. The University of Michigan's Consumer Sentiment Index declined to 68.9 in October from a 5-month high of 70.1 in September, reflecting a weakening in both current conditions and expectations. Conclusion: maintaining a bullish position. Despite mixed economic signals and market volatility, our analysis of the S&P 500 Index, SPX, strategy remains firmly bullish. Aggressive traders are encouraged to consider positions in the RIDEX Nova S&P 500 Fund RYNVX or other bullish S&P 500 index funds or ETFs like SPY. As always, investors should stay vigilant and informed, ready to adapt to changing market conditions while adhering to their long-term investment strategies.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.